Intro 0 pair 025. Welcome back, traders. This is part 5 of our Forex Strategy series. We've talked about trend, structure, flat zones, and avoiding fake breakouts. But today we talk about the most important topic of all, risk management and lot size. This is what decides whether you stay in the game or blow your account. If you're serious about trading long-term, don't skip this video. Let's begin. Most traders think they lose because their strategy is not good enough. But in reality, many traders lose because they use lot size too big. They don't know how much they risk per trade. They trade randomly without calculation. Here's the truth: a simple strategy plus strong risk management is much better than a strong strategy plus no risk management. Your first job as a trader is not to get rich fast. Your first job is a professional rule is simple. Risk only 1% to 2% of your account per trade. Example, if your account is $100, 1% risk, $1 or $1 per trade. 2% risk, $1 or $2 per trade. If your account is $1,000, 1% risk, $1 to $10 per trade. 2% risk, $1 $20 per trade. This means if your stop loss is hit, you only lose that 2%, not half your account. This is where most traders go wrong. Step 1. Know your account size. Example, $200. Step 2. Decide risk percent. Let's risk 2%, 2% of $200, $4 maximum loss. Step 3. Know your stop loss size, in pips. Example, your setup has 40 pips, stop loss. Step 4. Use this logic. The smaller your stop loss, the bigger the lot size can be. The bigger your stop loss, the smaller the lot size must be. You can use a lot size calculator on web or mobile app, input, account size, risk percent, stop loss pips, pair, e.g. USD JPY, XAU USD. It tells you the correct lot size. Teach your viewers, never choose lot size first. Always choose risk first. Your strategy already tells you where to place. Stop loss. Below last swing low for buys. Above last swing high for sells. Take profit. Next support, resistance. Or a fixed number of pips based on pair. Now connect this with risk. Example, buy trade, account, $500, risk, 2%, $10, stop loss, 50 pips. You calculate lot size so that 50 pips loss was $10. Now it doesn't matter if the trade loses. You already planned the damage. This is professional trading. The second big piece is risk to reward. Professional traders don't risk $10 to make $5. They prefer to risk $10 to make $20 or $30. This is called 1.2 risk reward. Risk 1, target 2. 1.3 risk reward. Risk 1, target 3. Even if you lose half of your trades, you can still be profitable with good RR. Example, you take 10 trades, you lose 5 trades, win 5 trades. You risk $10 each trade, target $20, 1.2. Losses, 5x $10, $50 loss. Wins, 5x $20, $100 profit. Net, $50 even with 50% win rate. That's why risk reward is king. Most traders blow accounts not because of strategy, but because of emotions. Revenge trading. Increasing lot size after a loss. Removing stop loss. Opening too many trades at the same time. You must train yourself to think like this. I want to win big today. I want to follow my rules today. Your goal each day is not to make $1,000. Your goal is, if you do that, the profits will follow. Here's a simple risk plan you can teach your viewers. 1 risk, 1-2% per trade. 2, maximum 2 to 3 trades per day. 3, maximum 3 to 4 losing trades per week. then stop trading. 4. No increasing lot size after a loss. 5. Always use a stop loss. 6. Never risk money you can't afford to lose. This will protect their account and their mind. Now show them how part 1 to 4 connect to part 5. You use market structure to find direction. You use trend line to confirm trend. You use flat zone to wait for best entry. You use income arrow to confirm breakout. Then you use risk management and lot size to control how much you lose if you're wrong. This is a complete professional trading system. If part 5 opened your eyes about risk and lot size, like this video, subscribe to the channel for more weekly Forex lessons. Share this with other traders who keep blowing accounts, and don't forget to join the channel. Membership for private trainings, live analysis, and deeper risk management sessions. Thank you for watching. Stay disciplined, stay protected, and I'll see you in part 6.